Silver just hit $94 per ounce. Not during a quiet earnings week, not during a routine inflation report, but immediately after coordinated US-Israel strikes on Iran. That timing matters. When missiles fly, markets reprice risk, oil moves, gold reacts, equities hesitate, but silver does something different. It does not simply respond to fear, it responds to stress inside the financial system. At $94, silver is no longer drifting, it is accelerating. Now look beneath the surface. Registered silver on COMEX remains tight relative to total paper claims. Open interest still represents significantly more ounces than what is immediately available for delivery. Meanwhile, physical premiums in Asia are holding above Western spot pricing. Those numbers do not scream panic, they whisper pressure. And pressure, when layered on top of geopolitical escalation, changes behavior. Capital that once chased yield begins seeking certainty. Traders who once leaned short begin managing risk. Volatility expands. This is not just a headline reaction, this is structural repricing in real time. If silver can break $94 in the first wave of escalation, the next question becomes unavoidable. Is $100 simply psychological resistance, or is it the next magnet if stress intensifies? Before we jump to conclusions, we need to separate emotion from structure, because in markets, the first move is rarely the full move. Before we go deeper, understand the difference between reacting and analyzing. Most investors will see silver at $94 and assume it is just another volatility spike driven by war headlines. They will wait for television analysts to explain it. By the time that explanation arrives, price may already be testing higher levels. This channel does not follow headlines, it follows structure. We focus on what the data is saying before consensus forms. Open interest, registered inventory, physical premiums, volatility, delivery mechanics. These are not emotional indicators, they are structural indicators. When geopolitical risk rises, most participants respond emotionally. Professionals respond by reading positioning. If you are here because silver just moved, that is fine. If you are here because you want to understand why it moved and whether the structure supports continuation, then you are exactly where you need to be. Do not accept any conclusion without verification. Check the CME reports, track the spreads, monitor the premium. Markets reward those who verify early. Let's remove opinion and focus on numbers. Silver is trading at $94 in Western spot markets following the US-Israel strikes on Iran. The move was sharp, not gradual. It pushed through prior resistance levels that had capped price in recent sessions. Now compare that to Asia. Shanghai silver has been trading at a noticeable premium relative to Western spot. The spread has fluctuated in the range of roughly $8 to $12 above COMEX pricing. That means physical buyers in Asia are effectively valuing silver closer to $102 to $106 equivalent, depending on timing. Premiums of that size are not meaningless. They represent real-world buying interest. Now inventory. COMEX registered silver, metal that is warrant issued and available for delivery, remains in the mid-80 million ounce range. Meanwhile, total open interest across active contracts represents well over 100 million ounces of paper exposure. That does not automatically imply shortage. Most futures contracts are rolled forward before delivery. But the ratio between deliverable metal and paper claims becomes more important during periods of volatility. Open interest has declined modestly from recent highs, suggesting some participants are exiting positions. At the same time, silver-backed ETFs have seen renewed interest, indicating that part of the capital rotation may be shifting toward physically backed exposure rather than leveraged futures. Now consider volatility. Implied volatility in silver options has risen significantly following the escalation. Traders are paying higher premiums for protection against large price swings. Elevated volatility typically signals uncertainty about short-term stability. Overlay the broader macro picture. Crude oil has risen on Middle East risk. Gold has pushed higher. Equity markets have shown weakness. The dollar has experienced intraday fluctuations. These are classic cross-asset signals of geopolitical repricing. Put the pieces together. Western spot at $94, Shanghai premium in double digits, registered inventory tight relative to claims, open interest still elevated, volatility expanding. This is not random price drift. It is a coordinated shift in positioning as markets reassess risk. To understand whether this move has depth, we need to separate paper pricing from physical demand. The $94 price you see quoted in Western markets is primarily derived from futures contracts traded on COMEX. These contracts represent leveraged exposure. The vast majority are never settled with physical delivery. They are financial instruments. Now compare that to physical markets in Asia. When Shanghai silver trades at a consistent $8 to $12 premium above Western spot, that is not speculative futures activity. That reflects buyers willing to pay more to secure actual metal. Ask the logical question. If $94 were the true clearing price for silver globally, why would physical buyers consistently pay the equivalent of $102 or higher? In normal conditions, arbitrage closes those gaps quickly. Traders buy where it is cheaper and sell where it is more expensive, compressing the spread. When the spread persists, it suggests friction in the system. That friction can come from logistics, delivery timing, capital controls, or simply stronger localized demand. But regardless of the cause, it signals that price discovery is not perfectly aligned. In calm markets, paper sets the tone. In stressed markets, physical matters more. War risk changes behavior. Industrial users may accelerate purchases to avoid supply uncertainty. Wholesalers may build inventory buffers. Investors seeking tangible assets may prefer allocated metal over derivatives. Paper traders react to price. Physical buyers react to availability. If the premium widens further while Western futures hesitate, the divergence becomes more meaningful. If the premium compresses, it may indicate normalization. Right now, the premium suggests underlying demand pressure remains intact. To evaluate whether $94 can evolve into $100, we need to understand how delivery pressure works in the silver futures market. Silver futures on COMEX represent standardized contracts for future delivery of physical metal. Each contract corresponds to a fixed quantity of ounces. However, most contracts are not settled with delivery. They are rolled forward before expiration. This is where First Notice Day becomes important. First Notice Day marks the beginning of the delivery window. If a long position is still open at that point, the holder can be assigned physical silver. The short position must be prepared to deliver. Now examine the structural setup. Registered silver, the metal designated and available for delivery, sits in the mid-80 million ounce range. Meanwhile, open interest across active contracts often represents significantly more ounces than that. This does not mean every long will demand metal. Historically, most positions are rolled forward. But during periods of heightened stress, the assumption that everyone will roll becomes less certain. This leads to the concept of the coverage ratio. Coverage ratio is calculated by dividing registered inventory by the total ounces represented by open interest. When that ratio declines, it means there is less deliverable metal relative to paper exposure. In stable markets, this imbalance is manageable because participants trust liquidity and settlement mechanisms. But when volatility rises and geopolitical uncertainty increases, confidence becomes more fragile. Another key signal is the futures spread structure. In normal conditions, later month contracts trade slightly above near-term contracts. This is called contango and reflects storage and financing costs. If near-term contracts begin trading above later months, that condition is known as backwardation. Backwardation suggests urgency, immediate demand for metal rather than deferred demand. We are not in confirmed broad backwardation, but the structural ingredients that precede it are visible. Futures are promises, and in times of uncertainty, markets begin asking whether every promise can be fulfilled under pressure. Silver has a history of moving quietly for long periods, and then violently in short bursts. In 1980, silver rose from single digits to nearly $50 per ounce in less than 2 years. That move did not begin with unanimous optimism. It began with tightening supply, leveraged positioning, and macro instability. In 2011, silver again surged toward $50, during a period marked by sovereign debt concerns, aggressive monetary policy, and systemic uncertainty. Volatility expanded before the majority recognized the structural shift. What do these periods have in common? They were not driven solely by headlines. They were driven by imbalance. Imbalance between physical supply and speculative exposure. Imbalance between financial confidence and macro stress. Imbalance between what the market assumed was stable and what turned out to be fragile. In Reminiscences of a Stock Operator, Jesse Livermore described how major market moves often unfold while the public is still debating whether conditions are serious. By the time the narrative becomes obvious, the opportunity is largely gone. Today's environment is not identical to 1980 or 2011, but the ingredients, geopolitical escalation, elevated volatility, tight inventory, widening premiums, resemble early stress conditions seen in prior inflection points. History does not repeat in a straight line, but when structural tension builds, Silver has shown that it does not move gradually. It reprices quickly. Silver is not moving in isolation. The US-Israel strikes on Iran have introduced a new layer of geopolitical uncertainty into global markets. Whenever the Middle East becomes unstable, energy markets react first. Oil prices rise. Shipping risk premiums increase. Insurance costs adjust. Inflation expectations shift. And when inflation expectations shift, capital begins rotating toward hard assets. Silver sits at a unique intersection. It is both a monetary metal and an industrial metal. On the industrial side, global demand remains structurally strong. Solar panel manufacturing, electric vehicle production, and electronics continue to consume large volumes of silver annually. For several consecutive years, global silver demand has exceeded newly mined supply. Now consider supply concentration. Mexico remains the world's largest silver producer. Any instability, whether logistical, political, or security-related, can influence forward supply assumptions. Even without actual disruption, the perception of risk can alter pricing models. Then look at Asia. India has historically absorbed large quantities of precious metals during periods of uncertainty. China remains a dominant industrial and investment buyer. When physical premiums expand in those regions, it reflects real capital deployment. Layer geopolitical escalation on top of existing supply tightness and industrial demand, and the picture becomes more complex. This is not a simple fear trade. It is multiple forces converging: energy risk, inflation sensitivity, industrial demand, concentrated supply, elevated volatility. Individually, each factor might not justify a sustained breakout. Together, they create conditions where price sensitivity increases. Silver is reacting to more than missiles. It is reacting to systemic uncertainty, intersecting with structural supply pressure. Beyond spot price and inventory data, the derivatives market often reveals hidden pressure before it becomes obvious in headlines. One of the first indicators to monitor is the silver lease rate. Under normal conditions, lease rates tend to remain close to zero. When lease rates rise above 1%, it suggests increased demand to borrow physical silver. Participants are willing to pay more than usual to access metal, typically to fulfill delivery obligations or hedge exposure. Another signal is the swap rate structure. In stable markets, swap arrangements allow participants to exchange silver for cash and later reverse the transaction at predictable rates. When swap rates move sharply or turn negative, it indicates stress in sourcing physical supply. Market participants may be prioritizing access to metal now rather than relying on future availability. Then there is implied volatility. Implied volatility in silver options has expanded following the geopolitical escalation. Higher volatility means traders expect larger price swings. It reflects uncertainty and demand for protection. Volatility does not predict direction. It signals instability. When lease rates rise, swap conditions tighten, and volatility increases simultaneously, the derivatives market is pricing stress beneath the surface. That stress does not guarantee a breakout to $100, but it raises the probability of sharp, non-linear moves if pressure intensifies. No analysis is complete without examining what could invalidate the bullish scenario. First, geopolitical escalation can cool. If diplomatic negotiations reduce tension, or if military activity remains contained rather than expanding regionally, the immediate risk premium embedded in silver could fade. Markets often price fear faster than they unwind it. Second, physical premiums can compress. If logistics stabilize and supply channels normalize, the Shanghai premium over Western spot could narrow. A shrinking premium would signal reduced urgency in physical markets. Third, ETF flows can reverse. Silver-backed ETFs have attracted capital during recent volatility. However, if equity markets stabilize or risk appetite returns, investors may rotate out of defensive positions. Large ETF outflows would add available metal to the financial system and apply downward pressure to price. Fourth, futures market mechanics can intervene. Exchanges can raise margin requirements during high volatility. Higher margins force leveraged traders to reduce exposure. That type of mechanical selling can produce sharp pullbacks, even in structurally strong markets. Fifth, volatility itself creates two-way risk. Elevated implied volatility increases the likelihood of sudden multi-dollar swings in either direction. A $5 decline can occur as quickly as a $5 rally under these conditions. In short, $94 does not automatically lead to $100. Markets overshoot in both directions. The question is whether structural forces outweigh normalization forces. If silver is going to move from $94 toward $100, the confirmation will not come from headlines. It will come from structure. First, monitor the Shanghai premium. If the premium expands beyond the current $8 to $12 range and sustains that level, it suggests physical demand remains strong. If it compresses quickly, urgency may be fading. Second, track registered inventory on COMEX. If registered ounces continue declining while open interest remains elevated, coverage tightens. If inventory begins rising meaningfully, delivery pressure eases. Third, observe the near-term futures spread. If the March-May or front-month spread shifts toward backwardation, where near-term contracts trade above later months, it signals immediate demand for physical silver. That would represent a structural change. Fourth, watch open interest behavior relative to price. If price rises alongside increasing open interest, new longs are entering the market. If price rises while open interest falls, the move may be driven primarily by short covering. Finally, monitor volatility. If implied volatility continues climbing as price advances, the market expects larger swings ahead. If volatility contracts while price stalls, momentum may be weakening. Structure leads, sentiment follows. Silver at $94 is not just a price level. It reflects capital adjusting to geopolitical uncertainty, energy risk, and structural supply tension. It reflects a market that is reassessing stability in real time. But price alone does not determine outcome. The real signal lies in the structure: physical premiums, registered inventory, open interest dynamics, futures spreads, volatility behavior. If those variables continue tightening while geopolitical stress remains elevated, $100 becomes a realistic target. If premiums compress, inventory stabilizes, and volatility fades, the rally may pause before testing that level. Markets do not reward conviction. They reward discipline. War headlines create noise. Data defines probability. Verify the numbers. Track the structure. Separate emotion from analysis. This is not investment advice. It is structural interpretation. In times of uncertainty, logic outperforms reaction.